Hey everyone, welcome to Fintech Corner. My name is Joseph Drambarian. I'm the Chief Product Officer here at Trovata, and I'm joined by my co-host, Brett Turner, our founder and CEO. And I'm really excited about today's episode because we're joined by a very special guest, Paul Przybylski, who's Managing Director of JP Morgan's Asset Management Liquidity business. But I think the reason why we're excited to have Paul on is because he is also the head of a product named Morgan Money. It's an exciting new product that we're actually very passionate about because we've also, we're excited to be announcing a partnership with Morgan Money and a deeper integration. And so for those of us that don't know anything about Morgan Money and kind of understanding a little bit more about it, I'd love to kind of dig into that and understand a little bit more about how did Morgan Money get created? What is it? And what is kind of the backstory behind it? And Paul, thank you so much for joining us and kind of giving us insight into all of that.
Yeah, thanks, Joseph. Very nice introduction, and congrats on getting my last name right. That doesn't happen often. But yeah, Morgan Money. So I think, when I kind of go back to 2019, right? My boss, John Donahue, and I were sitting in a room, and we realized at that time how important technology was and how our clients traded using technology. So to give you a bit of a background, in our industry, which is about $4.5 trillion in the U.S. market, slightly over 40% of that number trades electronically. So it became pretty evident to us at that time that we got to really step up our digital distribution game. And we did the whole internal rounds with our seniors, ultimately went up to Jamie Dimon and presented our business case, which was essentially to launch a open architecture trading platform, which will be built ground up from zero, all internal proprietary technology. And what we wanted to do was really go out to market and prove that a large bank like us could run a startup business within it. So that's how Morgan Money essentially became the product now, which ultimately is a business within our asset management arm. And luckily, I was fortunate enough to have a very strong team with me. We built everything ground up, and now we're out there competing in the space, with the rest of the industry. And I think that kind of what drew our attention to you. I think we had a lot of common vision. Our platforms, I think, are very much similar and cutting edge. So I think, that's the exciting part of connecting with all of you, with you and Brett.
I think Brett knows very well. There's nothing I love more than a skunkworks story. They're my absolute favorite. So would it be fair to say that this is kind of like the JP Morgan's SR-71 Blackbird story, if you will? It's an amazing project.
Yeah, I think when we started, we had no idea where it would go and what it would look like in the end. I would say you can only imagine how difficult it is in one of the most regulated companies in the world to launch a proprietary trading client-facing application that's not only for JP Morgan products, but also for non-JP Morgan products across 86 countries where we are at right now. So it was pretty intense, but luckily we had the right plan, the right team, the right execution, and the right buy-in. So I think where we are today is also thanks to a lot of our hard work and dedication. I think we're not only just a front-end technology for our clients to trade, but also we scaled the platform to an area where we're able to actually offer it as a software as a service for other intermediary banks, which is a very different, unique piece of business. So I think, when we see how we got here and where we are today, I think we are probably 60% maturity from a level where we want to go to, and the next 40% is going to be even more exciting, probably in the first 60. And partnering with Brett and his team has been one of the huge milestones, I think, in our journey.
That's amazing.
And I'll just kind of add a few things because Paul's being modest too. I mean, I don't just to get some perspective of why we were so impressed, why I was so impressed too with the journey is it's really rare. It's rare to get, first of all, the kind of support that, and I think hats off to, I got to meet John Donahue and just seeing his his passion for the project too, which I know was a big part of convincing him probably too, but also him being a part of that, but supporting you, Paul. And I could just imagine the work that you guys had to do to kind of team together and really ring fence this within, the largest bank in the world, with all of the aspects of how hard it is to incubate and build a new innovative product. And again, no, I'm not saying any offense to we, JP Morgan is an investor. We work closely with them, like a lot of banks, and we love our banking partners. And we've been pioneering APIs with them on the transaction banking side. But I just know how hard it is to really drive innovation, or for them to drive innovation. That's why we're doing it with them. But it was sort of kind of this cool, refreshing moment when we first met you guys, and just that you guys had done it. You guys had actually done sort of the unthinkable, building something new, something modern, a lot of legacy tools out there. We looked at them because we were looking at partnering on who we could partner with too on this side, and just seeing what had been built and seeing what you guys did and the fortitude to sort of make that happen in a fairly short period of time. I can only imagine how hard that was and how you had to contend with a lot of aspects to get through that journey. But I mean, now that you've done it, and now that you kind of keep, proving your way through that, and now that we're getting a chance to work together and seam up really kind of two best-in-class solutions, it just feels like the sky's the limit.
No, definitely. It's I would tell you from experience, like the first year was very tough. So that was November 19, and then COVID hit, so that was even tougher. So like when all teams got decentralized, we managed to pull that through. And when you kind of look at Morgan Money now, it's a independent, almost a company within a company in a way, the way it's structured. So we have a marketing team, we have a tech team, we have a client service team, we have a sales team. So it's a very much a business wrapped within a business, and working with Trovata. I mean, it also kind of keeps us on their toes to be nimble, so we don't fall into that bigger banking mindset as we continue to push forward.
I think the thing that I've loved just kind of getting to know you guys and getting to know you, Paul, is how much you care about the experience. And that's something that's just so core to everything that we do at Trovata. So being able to work together on something and just seeing that we both care a ton about the end client experience and how they get value out of both of our products, that's been one of the things that I've also thought are one of the differentiating factors of this relationship. Because as we looked, in the marketplace at not just TMS solutions, but other solutions to kind of support your investment strategy, it's old. It's old, and it's not good.
Heavy. It's heavy. It's table heavy.
Yeah.
It probably at the time when it was launched, it was, great, but 10 years down the road, it's no longer what it's supposed to do. And that's the piece that experience for me needs to be continuously enhanced.
Yeah.
Especially when you kind of think about how our demographics of our investors is changing over time. Like if you think about today, that investor demographic is around, that 40, 50 age.
Right.
Ones coming up are, 20s and 30s, where their experience is going to be even more revolutionary to where we live today. So like far more enhancements in how the structure of experience works, far more efficient, and most definitely it needs to be sitting on a mobile platform. That is where it needs to all get to. So just by the force of our investors, we have to continue to innovate.
It's amazing. Yeah. And I think that you can see it just in how breakthrough the product is. As Brett said, it's best in class by far.
You guys are making me blush.
Young people are using Robinhood and Reddit. So I mean, the shift has to start coming. You're being too nice too, Paul, when you say like, what else is out there? It probably was nice 10 years ago. I would just say, well, maybe you mean like 30 years ago.
Listen, you got to stay humble, man. That's kind of how I live my life every day.
For sure.
I'm just going to kick this off today with like one of the openers that we've been doing over the last few weeks has been focusing on really what does AI mean long-term for the topic that we generally discuss: fintech, cash management, investment, etc. Well, yesterday there was a news story that kind of introduced the fact that the API that ChatGPT has been using over the last few weeks and months has gotten a big evolution of just to a new major version 3.5. And so what I thought was, Paul, since we have you here, I'm just going to throw you right into the sharks, and we'll see what we get in terms of an answer. But what I'm curious is, how do we feel about the possibility of AI playing a role in the environment that we're in right now, right? Because interest rates are at an all-time high if you are on the corporate kind of cash management side. Obviously, if you're on the consumer side, this isn't good. If you're trying to buy a house, this is like, oh, maybe this isn't the best year to be buying a house. But if you're on the flip side, this is an amazing time. So how do you guys feel about all of the folks that have been jumping into ChatGPT and typing in, hey, I have $10 million of excess cash. What should I do with it? And
Well, I think it's a bit more complicated what to do with that 10 million bucks once you type it into the chat. But listen, I think, if you think about the big picture on AI, it definitely attracts a lot of money and attracts a lot of computer scientists, and it does have a lot of usages, but you also got to think about, it's pretty new, right? And if you think about the innovations of the last 2 years, we had the metaverse, we had hydrogen, we had buy now pay later fintechs, we had crypto, and for the most part, those things have not necessarily materialized to the hype they had. So I think with ChatGPT, and it's I was kind of thinking I was read an article a little bit earlier about it. It has a reported IQ of 147, which is like the 99.9 percentile. But it's still got to get a little bit better, and routinely does make mistakes, or what they call effectively hallucinations, where sometimes it doesn't understand what year it is, incorrectly states Croatia has left the EU. So there's still a little bit of work to do before we can use ChatGPT in the investment universe to your example, type in, I have $10 million, what do I do with it? That's kind of my initial thoughts as you throw me into it. So
yeah, I was going to say, I think Paul's got, the conspiracy theory is like Morgan Money is like there's a line of code that's being inserted somewhere along the line. So the answer is going to be, oh yeah, just go to the Morgan Money team.
Yeah, I mean, Morgan Money is run by ChatGPT.
That is so true, Paul. It's funny that you mentioned that IQ thing. It's something that, especially from an investment perspective, we've seen this too, just talking to clients, getting deeper into this topic as more and more people are asking about solutions and what to do, because everybody's reading the same headlines at this point, right? And maybe you could have been a more conservative operator prior to the rate environment, but now it's almost like you really have no excuse. That you have to do something. And I think as all of the flooding of the market has taken place in terms of products, in terms of technology solutions like ChatGPT or analytics solutions, it's really interesting to see how they all come together and create this kind of almost synergistic moment of what is the right way to approach the mindset, if you will, of maximizing excess capital. And I guess maybe that's the setup and the segue. And sorry for throwing you in there right with the sharks. I was just curious to get your take, but yeah, it's so thankful that you joined us on the podcast today, because I know that your insight in this space is better than I think anyone. And I'd love to hear more of your thoughts on what you guys have been seeing just generally in the topic of the rate environment and how folks on your client side, but also just generally have been navigating this topic. And I know we'll get into more detail, but high level, what has been your reaction, just kind of seeing the opportunity?
Yeah, I think, if you look at the products that, we look after from a fiduciary lens, is that, money market funds have been providing the highest yield in the last 15 years. And they offer liquidity, stability, and stability of principal, right? But you'd be surprised how many investors haven't necessarily revised their cash management approach just yet. I think since the Fed began hiking rates at basically a rate that has been at historic speed and velocity, it definitely lifted up the money market fund yield substantially. Think about it now, you're essentially getting 4.5 to 4.75% on the money market fund product, right? I mean, I think that is
That's wild.
significantly higher than what you have seen, right, in a number of years. So, our clients and investors are now starting to really rethink their liquidity management strategy as cash is an asset class that's essentially in play. If you think about year-to-date S&P return is just under 3% so far. Grant the fact we're in March, but if you think about cash is out yielding that by roughly 1.5%. So I mean, it doesn't mean that's how it's going to go all year, but it kind of gives you a lot of perspective that it's clients are able to earn a meaningful spread on money market funds, and that actually shows by the surge of inflows into the space. So in the U.S. market, kind of ground you some numbers, right? In the U.S. market, the money market fund industry is about $4.5 trillion, right? Pre-COVID, that number was about $1 trillion less. So you can see how much money has moved into this space, and a sizable percentage of that is traded electronically via platforms like Morgan Money or via different other platforms.
Yeah.
So money moves at very fast speeds in this business. Since these products are managed to a very high standard, and although there's differentiation between providers, clients do have options and ability to shift around very quickly, and that comes to the testament of what the technology does. I know we joked around starting with ChatGPT, but tech in the investment universe, like in the world of managing money, is very much alive and well. We use a lot of proprietary technology to size portfolios, rebalance portfolios, which historically was done by individual portfolio managers and spreadsheets, where now is basically push of a button type of an approach that allows you to use the time for thought process and portfolio positioning versus doing the manual work of manually sourcing the data out of Bloomberg and then effectively reallocating. So we kind of joked around it, but not necessarily full-fledged ChatGPT, but there's definitely elements of technology being utilized across the investment spectrum.
Well, Brad, that actually makes me think of, like, how do you kind of see the role of technology in all of this? Because you've been an operator at this point for a really long time in a CFO role, now as a CEO, and liquidity and maximizing that liquidity. You saw kind of every generation of that, right? Human capital being applied to it, just a bunch of folks going through reporting, providing you insight. And that might not be happening at the pace that we would need, given kind of what Paul is talking about here, right? If you have an opportunity to take advantage of a rate hike, and that's like maybe measured in a window of a week or 2 weeks or 3 weeks, whatever it might be, the old processes aren't really going to get you there, right? So what kind of technology do you need to have kind of in place to even react to these types of opportunities?
Well, and this is kind of, because I now kind of a follow-on question for Paul, and because you kind of look at this is exactly why we're partnering, right? Because technology, like we talked about ChatGPT, but just in general, there's just a lot of also low-hanging fruit with just basics, right? Just basic automation or things that we take advantage of in other sectors, and the cloud has driven all the innovations, but yet are just finding its way into finance 10 years later. We're driving this. It seems obvious to us, but a lot of customers are just don't have a lot of that good nice flow through with all their workflows, and it's really clunky, and they're having to depend on too many different things. But yeah, I think the reason why we're partnering just is to really accelerate that, drive some automation, make that easier to do, and excited. It's about our technologies kind of meshing together really well from that standpoint. But it also, like, when you think of those numbers, Paul, and what I'm hearing a little bit too, it seems like it should be more than that. I mean, if you look at like the last decade, it's almost been it's lulled finance for treasury folks to sleep a little bit, because there hasn't really been much of a yield opportunity. And then in the last year plus, it's just completely taken off. And now the boards are hammering CFOs and treasurers of just like, if you're not stewarding that cash into some yield opportunities, then you're going to have to answer some harder questions. Like, why not? There's a problem there. Like, you're not doing your job. And even when you look at the last with yield having been there for the last year plus, it still seems like there's a lot of companies that are really slow or reticent to even move into basic vehicles like money markets. But I know there was some things like back in 2008 when there was some liquidity concerns, and even in terms of money markets. But like that's all cleared up. These are all readily available. It just seems like the take rate should be more. How much is that of technology? How much maybe is just the kind of hesitation or reticence of investing in some of these other vehicles? And then third, maybe some of it is maybe just shaking off some of the rust. Say you got to now kind of do your job of investing when they haven't had to do that before.
Yeah, I mean, I think, you mentioned 2008, which is like, for myself being in this business for 20 years is like PTSD in a way, right? So, that event was primarily credit driven, right? So, that was more of a credit exposure perspective, and, certain investments shouldn't have been in the portfolios, but they were, and unfortunately it led to pretty bad outcomes. But you kind of look at now where we are. These products, money market fund products, are the most highly regulated securities like in the world, effectively, right? There is a significant amount of regulatory scrutiny. These products are very much in a preservation of capital first. Effectively, yield is a secondary aspect. But in the rates environment that we're at, in a government money market fund, AAA rated, you're essentially betting on the default that the U.S. defaults, which if that happens, there's obviously different circumstances will be happening in the world. And technology does play a role. I mean, I think if you are a corporate treasurer and you're coming to start your day, having a cup of coffee, you fire up Morgan Money and you look at where your money is sitting and where your yields are at, you can very easily rebalance your portfolio in a handful of minutes and then walk away. So, I mean, that's the partnership with you, Brad, is that, we want to bring that, execution of efficiency because, I'm not naive. I know treasurers have far more other things to do, more value-added tasks. And the whole idea is to give them that flexibility, essentially with the tech. And, keep in mind that when the rates where they are today, we do expect from if you think about what the market is saying, we do expect another 25 raise in March and in May, and then there's a 50% shot of it happening in June. But once the rates stabilize, it's also very important for treasurers to also not miss the second leg, which is the rates when they start coming down. And if they are sitting in deposit products, those deposit products will reset much faster, almost instantly overnight, whereas a money market fund will actually insulate them a little bit longer because it takes a longer in terms of the duration sitting in the portfolio that the portfolio manager can actually actively manage, which means they'll get a better return. Because I think what you were kind of alluding to is that, right now, corporate treasurers and CFOs got the taste of net interest income on cash that sits idle, and I think that's great. And now there's going to be a level of expectation to maintain that on the P&L. And one way is to just make sure that you have the right investment policy so you don't miss that leg down.
Be careful what you wish for. The board is saying, hey, maximize it, and then you do, and then it's like, oh, well, is this going to maintain over the next few quarters? And the answer is, well, we'll see what the market does. I think that's a great point, Paul. At the end of the day, I think one of the things we've also heard from our customers is, where do we even get started, right? Because this is, when you think about this type of policy, it tends to be one that is reserved for more sophisticated treasury operations, right? If you're sitting in a business that may be sitting on excess cash, and that might be a significant reserve, and you did that in the past because you were going through COVID, for example, right? And it was part of the policy coming from the board or from the business itself of having maximized liquidity in the event of some shortfall or in the event of some change or headwind economically. Well, the tables have turned, right? And things have started to stabilize on that front in terms of COVID, but now we're sitting in a different situation from a market perspective. How do you kind of advise or kind of give advice to first timers, right? Like how do you even approach this topic? Is it a balance of technology and getting the right advice? Like, how do you even navigate that?
It's definitely a mix. I mean, I think, when I talk to clients about the the investment policy or even broaching that topic, I think to your point, depending on where they are in the cycle of their maturity, is they're going to have two different answers, right? I have seen investment policies which are very detailed, and I have seen investment policies which say, purchase deposits. So I think with if you're starting out just new, I think there's a lot of we can provide definitely a lot of guidance and help with that. But I think you should also start slow and understand what are your financial goals as a firm, and understand what investments need to be married to that. Understand your cash flow. I think understanding your cash flow is hugely important in structuring your investment policy. And also at the same time, you have to remember what that cash is used for. So if you think about bucketing your cash into operating, which is basically your payroll, then you get into more strategic and reserve buckets. Your policy needs to account for those differences in products. But at the same time, you got to balance the risk versus the reward, specifically when it comes to cash. And I think, primarily corporate traders by definition are more risk averse individuals. So you're not going to see a lot of, emerging markets policy statements for cash reserves out there, but you will see government funds, treasury funds, credit funds out there in that spectrum, right? So I think we definitely, on our public, even on our inside papers of, basic blocks how to build an IPS statement. But I guess it starts with, the person doing it, understanding what are their actual needs of the firm and what stage of maturity they are to really write a meaningful starting point. And I can tell you that over time, as that company grows, that investment policy is going to change, because they will grow with appetite, and that will require revisions to that statement.
I think because I didn't really answer your previous question though too, Joseph, but this kind of hits squarely on it though, because at the end of the day, like this is Trovata. Trovata is the on-ramp, right? If you think of a lot of, and why we're excited to working with the Morgan Money team is because all this, they're making it easier. The tool makes it easier for larger corporates and treasury teams where there is some expertise. But then if you look at, you keep going down market, and then it just becomes harder and harder because there's less expertise, there's less volume of funds, there's less, maybe there's not good tools aside from Excel of kind of helping you with forecasting or understanding where some of those demarks are, where the liquidity lines are of like your operating cash flow, what's excess, or, and if you don't have good tools to do that, then you're having to hedge, and then you're putting so many layers of hedging on, then there's not much there excess to be able to do. There's not the volumes that are interesting to be able to then worth it to move those, is it a big enough chunk of money to move and then get yield on that amount? So like at the end of the day, this is what's so beautiful about this is with the how technology can play such a crucial role, is because if you can do that easily, if you can get that intelligence easy enough through that process, and that's what Trovata does, then you're really democratizing something that's really hard to do, that now is like, right, especially in these times, you got to do it. It's so ripe. It's like ripe fruit on the tree. Like you got to go pick that fruit. And so just making that accessible and doing, not only speeding that up and making it easier and better for larger companies, but with all the front-loaded intelligence to be able to do that even better and faster, but then also making it available, all the way down, companies that are, whether it's small enterprise or mid-market, and even down below that, if you can create some of these easy buttons or this easy on-ramp, so they're thinking, if they can think a little bit more from a business side, they know their business, they can think real, easily without having to have, all of that expertise in-house, or even having to build these partnerships necessarily that might help them kind of wade in or manage that, because those can be expensive if you don't have a lot of high volume dollars to do it. Like these are the things we're crossing the barriers. So democratizing all of this, working with Morgan Money, having all that intelligence, it just blows the doors open in terms of that market accessibility, customers that actually can participate and do this without, a massive heavyweight or anchor feeling like or preventing them from doing it.
Yeah, I guess, Paul, we're pretty passionate about this. You've probably heard us in meetings kind of going on and on about how we think we're transforming things, and it's because we have this thought that it should not be a complicated issue to figure out how much cash you're sitting on, right? And then the bucketing that you were talking about, having clear visibility into, hey, look, from an OpEx perspective, from a payroll perspective, from your cap, all the different categories that run our business, you should have a clear line of sight of where that money has gone and where it will likely go, just given best practices. And so whenever you get kind of Brett, especially, and then myself riled up on this topic, it's because we feel so strongly that that should not be a barrier to entry to making strategic and insightful decisions. Once you know, hey, look, we're sitting on excess, or we might have a shortfall, 2 months from now because of some strategic thing that we're going to do. And imagine if that was not a blocker and you had that kind of visibility immediately, right? It's not a matter of, hey, my task force of folks in accounting or an FP&A, go do this research for me so that I can make a decision at the end of the week. And then you miss out on any possibilities that might be playing out in front of you. And I know that we're not talking about short-term investment windows. We're talking about more strategic. But at the end of the day, it all kind of rests on the same principles. You need to be nimble with regards to this visibility. And I'm curious, kind of hearing us talk about all of this, like, what are your thoughts in terms of how a platform like Trovata would help kind of inform the behaviors of how you might think about opportunities with a product like Morgan Money? Because I know that we're working together for a reason, and we're really excited about that. But how do you guys see the angle and what it can mean for customers?
Yeah, I mean, I think, the way I kind of think about it is we've been working together for probably almost like a year and a half now, right? I mean, it's been a while.
Yeah.
I mean, I think if I had to summarize in a sentence what we're trying to do is like we're really taking insights and turning them into action, right? I mean, if a client is sitting on Trovata, right, and they're working towards understanding what their cash flows are, they see it, they feel it, they're about to, now they're ready to make that insight and turn it into action. And this is where Morgan Money piece comes in, is that we give them that flexibility and that tool, right, to give they know where everything is coming from. They've done the work that usually took probably far longer, far more efficiently. I would say definitely a lot more accurately, because in one of my old seats here, I was a CFO, fixed income and liquidity, so I can appreciate Brett's past history of like how painful it is to centralize and actually make a decision at that point.
Right.
But then when you're ready to make that decision, then the execution needs to be just as seamless as everything else, because that's where it matters, right? Ultimately, you can have the great insight, but if your execution is poor, then your outcome is going to be just as good as your execution is. So I think our really value add ultimately is, we allow, through this connectivity, insight into action is effectively painless, seamless, super easy to do. And everything is then connected on the way back, right? Just because then you execute through the trades, whichever ones you wanted to execute, information flows instantly back into Trovata, and you're moving on to the next steps. And you're living in that cycle that is very much automated in a way that allows you to not necessarily overly complicate your day, but at the same time maximize your value and benefit. Because even though, traditionally speaking, that analysis could have taken you a handful of weeks or a month, et cetera, then took you another handful of weeks or a month to execute. But think about it, that's 2 months out of 12 when you could have been earning 4.5%.
Right.
That's real money, right? At the end of the day, is to any corporate, realistically speaking.
And that's not counting the staff overhead. That's not counting kind of all the thought capital that goes into it, the lobbying that you have to do. And I mean, there's so much that goes into that whole process. And then it doesn't end at just 2 months, right? You have to keep iterating on it and reporting on it and providing that continued value. As Brett said, you can't just do it once, set it and forget it, and then that's it, we're done. I think that's the whole point, is that you have to almost transition to this mindset of it's evergreen. You never stop. Once you go into this mode, you won't stop, because there's opportunity. And so how can you give yourself leverage in that scenario? And the only way to do it is to have the right tools, is to have the right opportunities be presented to you so that you can make the right decisions. And I feel like that's the synergy here. That's why we're so excited. And I've been doing this over the last few podcasts. I'm using this as a social platform because I've been noticing I can get Brett to turn it on when it comes to value for customers in this platform. So I'm curious.
What am I going to give away now, Joseph? No.
I'm curious, Brett. You did this with payments in the last podcast, and that was fun. What about this side of the house? Because you said you democratization of this kind of tooling is important to us, and it's important to you in your personal journey and everything that has gone into Trovata. Are you prepared to make any offers to our audience about how they could take advantage of this kind of experience that is kind of end-to-end envisioned between Trovata and between Morgan Money?
Absolutely. That's the newsflash. No, I mean, yeah, there's just, it's so much at the heart of really, of what goes into Trovata, starting the company and just, again, it's a little bit like, we've all played as a kid, like the pin the tail on the donkey, right? You got the blindfold on and yeah, you're usually getting something on the board. You're getting, something close. Of course, it's fun, but it's like, it's a little bit like forecasting, and there's just not good tools to give you that intelligence. Like Paul says, the insights. And so if you lack the insights, you're not necessarily running things blind, but it's more opaque. And you get close. You're always kind of skirting around the bullseye. You don't really know where maybe the edges of risk quite are. So you just buffer. And I think at the end of the day, like if you can get precision, then you should be getting the bullseye every time, not once in a while, every time, and do it right away. Because if you're waiting and all this planning and conservative to get there, then you're leaving all this money on the table. So yeah, we want to do something, we want to do something special and continue to a little bit of our approach. I don't know, maybe being at Amazon once upon a time is a little grained in me, but I love the Amazon model where they're, especially back in the day, is constantly trying to, they're doing things to get leverage, and they're passing on that savings to their customers. And they're doing that, thinking, okay, that's altruistic. You're making it more accessible. But obviously it's helping Amazon too, because it's helping them grow and get more volume. And so it just is a win-win, that whole, virtual cycle. So I think for us, when we look at things like some of the investment partnerships and the integration, like we're doing with Morgan Money, the things we're doing with ERP integrations, or even with bank integrations, there's some of these things we just fundamentally want to bring those barriers down, because those are the ways to kind of get in, because it's all kind of data driven. And so, yeah, long setup to say that we want to make the integration and the experience that we're now doing with Morgan Money, we want to make that free to all customers. So it kind of starts with a few things. One, Trovata is now free to start up. You can sign up off our website. This is unheard of in the enterprise space. You can literally click get started, go through that process. We'll connect your first bank for free, not your first bank account, your first bank. We'll connect your first bank for free. And now we're going to include Morgan Money access in there as well. You can actually get free access, and the free connection that we've done, the integration of data flowing in, as well as the experience accessible to be able to get access to it from within Trovata. So those synergies are really high from just a workflow standpoint, like Paul described. So we're making that free. We're super excited about it. And I don't know, I think this is we keep gaining momentum to add, these pieces into this experience. This is a really key one. It's one that, yeah, we're super passionate about. I'm super passionate. I know Paul is as well, as where this is going to go. And it's going to be a game changer. So we want everybody to experience it.
Oh man, this is amazing. I'm so excited to hear you say that, because I really think that it puts all of our, money where our mouth is, if you will. We believe that this will be meaningful for our customers, and we want to get them in there, because the only way to get to the point of making these types of decisions is to have visibility. And Paul, I think at the end of the day, you and your team, you're set up beautifully, to drive value for customers that get to that point. And so this is why I'm excited. I'm excited that Brett is willing to do this in a public way. I don't know if you'd be willing to give your take on this announcement, but we're excited to be all in on this opportunity for our joint customers.
Yeah, definitely. I mean, I'm, I have been here long enough to understand what's out there in the market, and truly, I think what we have here is just, it's very, very amazing. I think at the end of the day, what we bring to the table, fully open architecture platform for trade any provider that client wants, and what ultimately the whole stitching to Trovata, the connectivity, and I think we have other things up our sleeves that we're working on together. Maybe we'll say
Yeah.
for the podcast, but this is, I think, a very strong beginning to a very good journey ahead of us.
Absolutely. And I think that the other exciting piece to anyone that's listening and kind of for the internet at a wider audience is we truly want this to be an experience that is open for everyone, right? So feel free to explore, sign up and get in touch, because the offer is true. Connect your first bank, get access to the Trovata platform, and then get access to the Morgan Money experience. And that end-to-end experience is one that you will not get on any other platform, and we feel very confident about that. So this is an exciting moment, an exciting day, and I wonder, Paul, just kind of having roll around in this topic now for 30 minutes and thinking about the opportunity. Do you have any closing thoughts? Given the opportunity that we're presenting with this offer, with just the general market conditions and how long it may last. You mentioned that there are still other kind of important milestone moments that are ahead of us that may impact and create more volatility to the situation. What are your thoughts kind of entering into the back half of the year, if you will? We're done with the first quarter. We've got the summer quarters coming up. What do you see as kind of the opportunities going forward?
Yeah, I mean, I think right now, what we're seeing on a year-to-date basis, money is definitely moving into money funds. I think, clients are seeing the spread. And if it depends on what kind of investor you are, if you do invest into credit funds, there's generally an outperformance over government by additional 20 to 30 basis points. So think about it, you're nearing 5% on that investment. So, as rates will most likely, from what is kind of baked in from a probability perspective, should increase by another 25 bips in March and May, so potentially 50% in June, and then they should level off. So think of like terminal rates around 5 to 5.25%. Expectation is from what I see in the market is that will remain static at that level for the rest of the year. And depending how the Fed carries and threads the needle on inflation, we'll see what happens in 2024, where there are some potential shifts down in rates. But think about it this way: like if you have two rate cycles of rates coming down from 5 to 5.25 terminal, you're still sitting in a 4.5% type of an environment, right? Money market funds are definitely a favorable investment. Obviously, we don't want to go back to where we were near zero rates, so where we were approximately three years ago. That was a very challenging rate environment. But I don't think we're going to see that anytime soon. I think and elements of the inflation we're seeing are effectively becoming baked in to our environments collectively in our economies. So I think rates will definitely be perhaps not as high as they might be by coming at the end of the year, but at the same time, they will not be drastically lower than what they were 3-4 years ago.
Yeah, and I think that the other story to tell here is that regardless of what happens on that front, this is just generally best practice, right? Getting into a motion of having a strategy with regards to maximizing excess capital and doing something about it, and having a platform that can support you in that regard, I think is also the story we're trying to tell here. That it's not just a moment in the market right now where it's like, let's get in while we still can. This is not a GameStop moment.
It's not a YOLO moment or a FOMO moment for sure. But I think
right.
You just got to be, you also don't want to be in a position of completely scrambling, right? I mean, if you want to have to your point, Joseph, you want to have a game plan, ready plan of attack, and the insight to be ready to execute. So, even if you're not interested or thinking about these kind of products now, that doesn't mean you shouldn't be ready to go when the opportune time arises, because it does take time to go through probably internal approvals on each of the the firm side. So I think it's prudent to be ready to go and ready to pull the trigger when the decision comes, certainly. And this technology, this partnership with Trovata, I think gives you exactly that. It gives you the best of both worlds, right? It gives you access to the insight and it gives you the access to the action, right?
Absolutely.
It gives you sort of that future proofing of what you can do as things change, right?
Yeah, you just got to be ready to embrace a bit of technology. I think that's really what I see probably as a stumbling block for some treasurers, perhaps, is that they kind of getting into that tech space. And I think, once they're there, I'm very confident they won't leave.
Well, we're getting ready to embrace the possibility of a future of humanoid robots and ChatGPT running everything. So I think embracing a little bit of technology is not a tall order. At least I hope.
Yes, exactly. Well, we'll see what the future podcasts look like, Joseph. So
yeah, I won't be here. It's just going to be a humanoid version of me. It's all going to be auto-generated. By the way, just on a comical note, we decided to run a script of what a podcast might look like through ChatGPT. Very scary. I don't want to read it. It is humorously and dangerously close to the types of topics that we would want to talk about. So who knows? Maybe I will be replaced as a host. You never know.
We are trying to save a little money.
There it is.
Well, the topics are only as good as the entire understanding and knowledge of what sits in the sphere of the internet. So that's how the chat bots get smart. So
that's
maybe
right.
We just got to tighten that up a little bit. It'll be fine.
Well, Paul, thank you so much for joining us on Fintech Corner today. This was an awesome discussion, and I really appreciate your time. And we're so excited about the partnership and what's coming ahead. So thank you so much, and hope you have an awesome rest of your day and weekend.
Thanks, guys. Appreciate both of you.